Hello everyone, and hope you're all having a great Wednesday. Thank you for joining us tonight. My name is Jean McDowell with TradeStation, and I'm looking forward to introducing you to our educational speaker tonight. Welcome to those of you that are new to Wednesday Night Live, and of course, good to see all you nice folks that attend every week. Wednesday Night Live is designed to bring you a different guest speaker every week, and that way you'll have access to a variety of trading ideas and methods and can stay on the cutting edge by constantly expanding your knowledge base. Keep in mind, these educators are independent and are not employed by TradersCoach.com. We don't guarantee their products and services, and on occasion, their opinions may conflict with the opinions of TradersCoach.com. With that said, we feel these educators have valuable information that you may benefit from, and we welcome a dialogue of different and sometimes conflicting ideas. So each and every Wednesday at 7:30 p.m. Eastern, we bring in a trading and investing expert to talk to us about different topics such as technical analysis, money management, trading psychology, and more. Also, as I mentioned before, these events are recorded, and provided that there are no technical issues, the recording will be posted in our archived events area on the TradersCoach.com website.
And thank you for that nice welcome. A couple of introductory things that let me mention. First of all, I want to thank Bennett and Jean for having me on, and I want to thank them for the contribution they make, specifically to the TradeStation community. They're on Bennett is on with us every Wednesday morning with our morning market briefing. It really provides perspective for people, even if whether you agree or disagree or follow someone's style or not. I think we've got such a nice rounded group of intelligent and experienced traders and analysts that it always gives people something to think about, and Bennett is really a contributor to that, so I want to thank him for that. The topic, you should be able to see my screen. Yes, apparently you can. I wrote a reintroduction to strategy trading for this topic. And let me give you a little background, tell you what I want to talk about tonight, and tell you a little bit about strategy trading to put it in the right perspective. Many of you may know, and I see some names on here of people I've known for quite a while, many of you may know that TradeStation, originally under its name Omega Research, made its name in strategy trading. That was really one of the areas that the company pioneered, the ability to write a set of rules, backtest those rules, and eventually, as markets became electronic and it was easier and easier to have access, to actually automate a set of trading rules. Actually, I worked in the early 1980s. I worked for at the time we used to call a systems trader, who was a protege of Richard Donchian. The name Donchian might mean something. I didn't know Mr. Donchian, but she was a protege of his. And she was one of the earliest, and she's still around the business, very well-respected woman, one of the earliest systems traders. And one of my jobs there was to calculate the moving averages every evening, yes, with a calculator. And then we got an audio couple, and we got mainframe time from the company to actually have them print out on our little dot matrix printer. And we used to do all the charts, the daily charts by hand, and wait every Monday for the new chart book to come. But she was one of the earliest systems traders. Yes, Carlos, she was a trend trader, and most systems traders were trend traders, because you had to remember we were dealing in a world where there was only daily and greater data. You couldn't really build intraday bars. You couldn't calculate your technical analysis intraday. It just really wasn't feasible. And to be any kind of a disciplined trader almost strictly meant trend following. I'm sure there were exceptions, but almost strictly meant trend following. In fact, even before I worked for her, one of my first jobs, if any of you use point and figure, you can appreciate this. Point and figure requires some intraday data. There are workarounds, but it really doesn't. One of my first jobs as a runner on Wall Street is I would go from the office over to, from our office at Battery Park over to Broad Street in Lower Manhattan to the office of a statistical service that would give us all the reversals in a table. It would give a list of all the reversal points for futures. And I would bring them back to the office, and somebody would take those and actually, with a pencil, make the point and figure chart at the end of the day. Well, certainly strategy trading, system trading becoming strategy trading, has changed quite a bit, and really it is the computer, is electronic, that has really opened the world up, and TradeStation was a part of that. I'm proud of that. But let me stay on target with the discussion. At this point, in some ways, strategy trading has become a little bit passé. You know, we take so for granted that TradeStation can do it, and some people don't trust it. And of course, this whole broader, using the word algorithmic, which is in some ways a longer word for the same thing we're talking about, it's been much maligned. And that's why I call this a reintroduction to strategy trading, because there are many people involved in markets actively trading who've never really given some thought to strategy trading. And I like to open the conversation up beyond strictly the idea of I have a strategy, I turn it on, it makes my trades. Many people do that. There's nothing wrong with that. I'm being more flexible in saying that having a set of rules, testing that set of rules, is a positive step. You know, we all know, or we all say we know, the trader has to have a plan. But I think it's also a positive to test the plan. Even if one doesn't automate the full execution of that plan, testing it debunks mythology. Testing it lets us know if the conventional wisdom really has any wisdom in it. And then at some point you may want to refine it to something you actually do automate, or it may just be something academic that allows you to really reflect on what you do. You know, there are people who will quote a piece of the, as I said, conventional wisdom, and then if you actually did a statistical test, they find out that that conventional wisdom is only right a fraction of the time, and it's not really an edge. So in this discussion of strategy trading, I want to keep it to its broadest definition. Certainly we're going to do some work in TradeStation. But I want to keep it to that broad definition of, you know, if I had a set of rules, could I test it? Would I learn something? Would it help me be a better trader? And ultimately, maybe there are some of you who do want to actually create something mechanical that they would follow, you know, and actually automate. So keep all those open. Keep your mind open. Keep your don't prejudge where we are with strategy trading, because I don't. It can be used in a number of different ways. We'll see if we can come up with some interesting academic examples, to say the least, tonight. I must, of course, go through the obligatory. Oh, let me give you my contact info even before I go through the disclosure. There's an email address on there, tslabs@tradestation.com. You're welcome to contact me at that email address. If you lose it or can't find it and you send Bennett or Gina an email, they can pass it on to me. I'm more than happy to reply. There's some information there on some of the things on our site where you can find some of our work. I'll give you a specific link to something a little bit later. But the most important thing here is so you have some reference to my name, of course, and that tslabs@tradestation.com is an email address that you can use for me. Here's the obligatory. I don't want to make light of it. This business has too many people in it who are disreputable, and we have to be honest with each other about the risks we are and are not willing to take, and about what we are and are not trying to accomplish. So please do be prudent with your risk capital. Think that out. We're not a recommending firm, so whatever I discuss here is meant to pique your interest educationally, and of course in TradeStation, we hope. And the things I will present here are based on legitimate technical analysis, and whether you go forward with that is strictly up to you. Finally, don't forget that now that we have this wonderful, incredibly fast network that we use all the time, remember that we are now subject to those outages, and even those brief 2-second pauses, if we have a little hiccup, seem like an eternity. To wax eloquent one more time about the old days, I can remember when the exchange would close. I was mostly involved in futures back then because the phones went down. So the phones would go down maybe to the COMEX or the Cotton Exchange, and they would close for half an hour until they got the phone system fixed, and then they'd reopen. This was, of course, only the days of pit trading. Absolutely. Okay, so let's talk about a few things related to strategy trading. This is a little bit of an extraction from some longer presentations I do about actually developing strategies. But keep in mind that you've got to ask yourself, you're going to work towards answering, but you've got to ask yourself a few questions to start to put a few models together, to start to think some things out. And as I said, this is a process. If you were going to design a home, if you were going to come up with a business plan, like any other business plan, you would first list what are the main things I have to think about. Well, let me start with this premise, and then maybe I have to adjust it. So the first one I wanted to mention was time horizon. And what I mean in the context of strategy trading was, what is my expected holding period? What velocity do I want out of my capital? How actively am I trading? That's this time horizon question. So I broke time horizon possibilities into three categories. The one that is actually a strict category is day trading, and we'll see an example of this in a few minutes when we switch to looking at some strategies. Day trading, the definition of day trading is that you go home flat. You start the day flat, you end the day flat. That is day trading. If you want to experiment with a model, and again, it could be for academic purposes, it could be something you'd actually like to automate at some point. If it's a day trading strategy, that has to be the rule. The biggest pitfall for anyone who thinks they're a day trader is I'll hold this one. I'll hold this one overnight. And then, of course, what often happens is the first time you do that, you're right, and it works well. So, of course, you're tempted to do it again. Now, a day trading strategy is a little beyond what we're going to talk about tonight. A day trading strategy could have in it a rule that says under certain conditions I hold, or under certain conditions I hold a half a position, half size. I think those are all legitimate if they are built in as rules with rationale. Otherwise, our definition for day trading, enter and exit each day with no position. Day trading is exceptional in that we have an artificial or self-imposed time limit on our trades. The downside for that is that there's a lot of money made at night, or could be. The upside of that is there's a lot of money that could be lost at night, and a lot of sleep that could be lost at night. Now, what most people refer to as swing trading, I sometimes call day-to-day trading. When I hear swing trading, I think of price swings rather than time swings. And that's why it's usually called swing trading, but I refer to it here as day-to-day trading. Usually positions held for several days. This is across the board, Carlos. This is any markets, and I'm going to show you examples. I have examples I use SPY, I use currency pair, I use futures. So you'll see a few examples in a few minutes. The day trading question is a little different in Forex, I would agree, if that's what you're alluding to, but stay with it a minute and I'll come to that. So swing trading, positions held for several days. Position trading, positions held indefinitely based on market action. What's the difference between swing trading and position trading? Well, since I'm discussing time horizons, that's kind of why I mentioned that day-to-day trading is kind of my preferred phrase, because it gives us a time connection to hang our thoughts on. But the difference between swing and position in that sense is that there's no artificial time limit. Just with swing trading, we're delving down into more smaller price movements generally than what we'd normally call position trading. Now, I want to talk a little bit about chart types. We'll take a look at them in TradeStation. But this is something very important that I want to mention. It's going to come up as I show you charts. It's also going to come up a little later when you see some of the back tests that I created for this demo. And I feel very passionately about this. I talk about this all the time. So if you've heard me speak before, you may have heard this, please bear with me. Technical analysis is a statistical study. Dry as that sometimes sounds, it's a statistical study. The chart type and the interval that we use are the data sampling rules for our technical analysis. We tend to relate to the chart as a picture. Now that sounds pretty stupid because the chart is a picture. It's a graphic display of market data. But don't think about the graphic side. We're working now in an area of trying to search through large amounts of data, a very long time series with a lot of data in it, get through the noise and find significant information in that noise. In that sense, ask yourself, how am I sampling that data? Whether that answer becomes a 3-minute bar chart, a 30-minute bar chart, a daily bar chart, whether it becomes point and figure, or Renko, or Kagi, or any of those. That's the question we're looking at here in terms of market data, the chart type and interval. It's the data sampling rules. You know, strategy traders are often accused of curve fitting, and that accusation is often on target. But usually when people say curve fitting, they say, well, let's take the data and a set of rules, trading strategy, and let's make the rules fit the data. Let's bend the rules to fit the data. So I come up with a great strategy for yesterday. Now we need testing on historical data to give us any feedback, but we run the risk, and there are ways to reduce the risk. Traders change time frames in sample, out of sample, but nonetheless we have to be aware of this risk of curve fitting. And yet sometimes I will meet people who will say, well, you know what, this didn't work very well on a 7-minute chart, but it made a lot of money on a 9-minute chart. So while the strategy developer is often accused of curving the rules to fit the data, what I just described was curving the data to fit the rules. And that's at least as egregious. So what I'm encouraging here is, and we'll see this as we look at some of the examples tonight, what I'm encouraging here is, think of this not as what makes a good picture. Think of it as what makes sense in sampling the data. Now, as you'll see in a few minutes when we get to this, obviously if you're a day trader, you're going to take more frequent samples, shorter interval bars. If you're a position trader, you're going to sample less frequently because you're looking at the market at a different scale, at a different, cutting noise out at a different frequency. So don't think so much of the picture. Think of it as what makes sense and how I sample the data. You'll see that a little more as we get into these examples. I harp on that a lot. I don't think it's a make or break, as you'll see, but I think it is important to start with a sound data sampling and then look to see how the rules and the data interact. Now I'm going to click over to TradeStation. You should see TradeStation with 3 charts in here. I just want to make a point about this. Stay with me 1 second. I'll make this a little easier to see, I think. Okay. 1 more minute. All right, good. You see 3 charts up here. Each chart is a conventional bar. In other words, the display characteristic is a conventional bar, open, high, low, close. And yet they are 3 different chart types, and each one represents a different category of chart type that we have in TradeStation. And of course, it's important to a technician and a strategy trader. So the first one on the left, if you look up at the status line at the top of the chart, you'll see SPY 15 minutes. All 3 of these charts are the SPY, the S&P ETF. The first one is 15 minutes, which means the first one is time-based. Now, we talked about data sampling. It is a picture, but think of it as a 2-dimensional representation of the time series. Price is on the y-axis, time is on the x-axis, price over time. And that's, of course, a conventional chart. We're choosing to sample the market every 15 minutes, or to condense the market into 15-minute packets, if you will. Now, it doesn't matter how much price action there was in those 15 minutes. It doesn't matter how much volume there was in those 15 minutes. It doesn't matter how many ticks there were in those 15 minutes. Nothing matters in either of those 15 minutes, in any of those 15 minutes, except the fact that we had a 15-minute piece of time. Okay. And then we summarize the 15 minutes with open, high, low, and close. All right. Time-based bars. Now this next one says tick bar. So a tick bar is an example of what we call an activity-based bar or an activity-based interval. Remember, the bar structure is still price. It's still open, high, low, close. There's a reason I push them together, and it's a little more crowded, and I'm going to tell you what that is in just a moment. In this case, each bar represents the price that occurred over 5,000 ticks of trading. So there were the bar opens. There are 5,000 ticks, regardless of the volume of each tick. A tick means a price report that comes down the pipe. The 5,000th tick closes the bar. The next one opens the next bar. I chose 5,000 just for an example. There's no magic in that. Now, what you see in both of these first two charts, in fact, let me make this a little easier to see. Okay. Now you see those two again, the time on the left, 15-minute, 5,000 on the right, and I will spread these bars out just a little bit more. The yellow vertical is the start of today. That's today's action. We had a pretty soft day, obviously. We all know that. That's today's action from the yellow vertical to the right. So look how many more bars there were on the chart on the right, on the tick bar. Now I'm just pointing out the difference so you get a sense. More bars means, remember we're statisticians now, more bars, more data samples. And all our indicators, whether it's a moving average or an RSI or any other oscillator, channels, they're all based on bars. Or at least all those categories are based on bars. So if it's a 20-bar average or a 50-bar average, well, they're going to be different because of a different number of bars covering the same span. This is now price over activity. And it may reveal more interesting price points. I don't know that there's a great example here necessarily right away. I'm not trying to make more out of what you're seeing right now, but you certainly see a difference. You certainly see a difference in the number of bars today. Now the last chart, I'll just bring this up and spread it out. I think you can probably see it okay. This doesn't have a yellow vertical because of the nature of the chart, but where my pointer is, this was the start of today. So you can imagine there was a yellow vertical. If you look at the x-axis, you'll see the date 12/10. Now this is what's called a price-based interval, because each bar in this case is 20 cents on the S&P, on the SPY. Each bar is 20 cents. The bar opens, it stays open for 20 cents, then it closes. Could take just a few ticks to make a 20-cent range. It could take a long time when the market's quiet. So this is price over, well, I was going to say price over price, or price over action, price over price action. Each of these, and I think I just reordered them, but you still see the same three charts. If you look at the status line, you can see which they are. Each of these are different ways of sampling the data. Now, most of us use time-based, and there's nothing wrong with that. Time-based has certain advantages. We know exactly how many bars we're going to get per day. We know exactly when the bar will close. And I tend to use time-based in my work as well. But I encourage you to perhaps look at some of the others. There are, offhand, of course we have time-based. There are 2 activity-based bars, and I believe we have 7 price-based intervals. Now, any of these, by the way, just as a quick footnote, any of these could be candlesticks, because a candlestick is a display structure highlighting the relationship of the open and close of the bar. I left these as conventional bars just to be able to see them. But candlestick is not an interval setting. Candlestick is a display style. Again, highlighting the relationship of the open and close of the bar and the open and close of bars in a sequence. In this case, that wouldn't change the bar interval, and that's really what we're driving at, the sampling of the data. That's really what this was about. I probably went on too long with that, but nonetheless. All right, so we talked about market data. I don't know what I'm going to use to begin with, time-based, activity-based interval, a price-based interval. I don't know, but as a good scientist, I'm going to make some assumptions, recognizing that through my experimentation, I may need to change them. Now, certainly if I'm a day trader, I need to construct a lot of bars per day. I don't know what a lot is, but I need trading opportunities. So I'm going to use a short intraday interval, whether it's tick or price or time-based. For swing trading, I'm going to use intermediate to long intraday intervals. And we're going to talk more about time-based and focus on that in a minute. And of course, for position trading, I'm going to look at longer intraday intervals, perhaps up to weekly, perhaps even longer than weekly. That depends on the strategy you're building and how you think it would fit. All right, so coming back to this time-based interval idea, I want to talk about that for one more minute, and you're going to see it because we're going to switch back into TradeStation. For intraday trading, no, let me rephrase that, for day trading specifically, day trading presents unique challenges because we have this self-imposed time limit, which is the end of the day. So what do I need as a day trader? I'm going to give you an example, and I'm actually going to show you one example that counters what I'm about to say. But as a premise, if I'm starting this project, I'm going to say, okay, I want to day trade. I'm going to experiment with a day trading model. I don't know if I'm going to trade it, but I'm going to try and build it and test it and see what I learn. And in building that day trading model, how many trades per day do I think I want to get? These are open questions, but start with some pencil and paper and think about it. Okay, I'd like to get 8 to 10 trades per day. And don't take that as anything other than a dialogue. So if I want 8 to 10 trades per day, and I'd like 5, 6, 7 of them, I'd like to have a high win rate. They're not going to be home runs. But I'd like to have a pretty high win rate because I'm day trading. I just need to generate some positive results out of the market every day, and I'm not trying to forecast the economy. So in order for me to have, depending on your style of analysis, in order for me to have about 8 or 10 trades a day and have a 50 to 70% win rate, what bar interval do I need? That's rhetorical as well. Am I trading Forex? Am I trading stocks? Am I trading futures? What kind of market? When is the volume in the day? We're going to talk a little about that. But those are the kind of questions to ask and consider in looking at this. And I want to talk about one more thing related to time, and then we're actually going to look at, well, start to look at some strategies. The other thing I want to talk to you about time, actually hang on to that because I'll show it to you in TradeStation. So what we've been talking about is what's my premise? What am I trying to accomplish? One other word of advice I have for you, if you're starting this out and trying to put together some ideas and experiment with some models, which I wholly encourage you to do, don't worry about where it ends up. It may end up in the trash. It may end up an automated strategy that you love. Probably it'll end up somewhere in between. Guaranteed you'll learn something if you make the effort. But if you're going to do that, don't try and do all of these at once. Pick a concept. Build a single model. See what you learn, see where it goes, then you may want to build another model. We talked about time horizon, market data, charting. Let me talk a little about strategy type. There were 2 that I want to discuss. I categorized types of strategies into 2 very, very broad categories, but they fit with the 4 strategies I want to show you. I want to show you 4 different strategies. So 2 of the strategies I'm going to show you are trend following. So a trend following strategy is exactly what it sounds like. The credo we used to say is buy high and sell higher. You're not picking the bottom and picking the top. You're waiting for the market to show you direction, and then you're getting on board. So if you always feel that, oh, I missed it and I can't pay up, then it's going to be very hard for you to be a trend follower. A trend follower generally has a small percentage of winning trades. This one you could write down if you want. This is in the strategy traders or the system traders canon. Trend following strategy usually has a win rate of 30 to 40%. That's not a return. That means out of 100 trades, 30 to 40 are profitable. It's amazing how many strategies I play around with and test, even just informally. And it'll lose a lot of money in a test, but it was right 36% of the time. Or it broke even and it was right 38% of the time. I see your question, Carlos. I've been thinking about it since you first put it up there. And I'm going to stall on it a little bit more. I don't know if categorizing it helps the conversation, so hang on. And we're going to see that borne out in some of the tests that I'll show you here. So a small percentage of winning trades, you have to be willing to live with that. It's meant to capitalize on the big moves in the market. When the market starts to go, whatever that market is, if you're a trend follower, you've got to go for the ride. You can't be seduced by the fact that you have some green in the position and you just want to book it. You're in to find those big moves, and when you get them, you got to stay in. Don't bail too early. Obviously, that's what the rules have to tell you. The psychological challenge, as I said, is you're paying up. You have to hold the winners. If you get real tempted to, gee, I have a profit, I got to book it, that's going to be hard for you to stay with. You always have to cut losses. There always has to be a risk control of some kind that is in accord with the strategy concept. The amount of give back from a position, the amount of risk taken when it's going the right way or the wrong way has to fit in, but there has to be some way to control the risk. So let's take a look at a trend following strategy, and it lets me bring up a couple of points. Let me tell you what the chart is. You can probably see it if you look at the status line. This also is spiders. It's a 130-minute bar chart. And this is the discussion I wanted to mention of time-based bars that I said hang on till I get to the chart. I talked about data sampling and having some logic to data sampling. And a 130-minute bar chart, why 130 minutes? Some of you probably know the trading day for New York Stock Exchange and NASDAQ regular session is 390 minutes. It's a 390-minute session. So 130 minutes gives me 3 bars per day. That's why 130. Much too long an interval for day trading. It's a reasonable interval for swing to position trading. I'll let you figure out where that gray line is. But it lets me sample the market 3 times in a day. And since I'm sampling based on time, each sample is consistent. I am sampling 130 minutes. Each bar represents the action for a consistent period of time. And by the way, some of this is the reason I also look at 65-minute bars. If you use a 60-minute bar chart, and I'm sure some of you do, we all do sometimes, I guess. But if you look at a 60-minute bar chart on stocks and ETFs, how many bars per day do you get? Well, you should know that you get 7. But that last bar is only 30 minutes. It's an inconsistent sampling, an inconsistent distribution of the action over time. It's not the end of the world. But for that reason, I prefer a 65-minute bar. So I get 6 bars per day. They are each 65 minutes. There's no short bar. And 6 bars per day is kind of interesting because I can see the day as the first and second half of the day, 3 bars and 3 bars, or even in thirds, 2, 2, and 2. I know some people who like to use 13-minute bars. Why 13? Well, 13, 390, gives me 30 bars per day. Each bar is the same length. It's consistent division. So, you know, the factors are whole numbers. And I get 30 per day. So 30 is a nice number for the day. I can see the first half, second half, or the first, second, and thirds of the day. So it's a nice data sampling. Make or break? No, but I think it's a logical foundation to work with. Some people like 13 also because it's a Fibonacci number. I don't know if that has anything to do with the bar interval, but you can think about that. So this is a 130-minute bar. That's why you see a lot of the gray verticals, because every third bar is the first bar of the day. And what you're looking at is a 9-bar price channel. So the blue line represents the 9-bar high, the trailing 9-bar high, and the red line is the trailing 9-bar low. 9 bars, 3 bars per day. It is not exactly the same as a 3-bar, 3-day channel because it's rolling 9 bars, but it is similarly reflective of 3 days because there are 3 bars per day, and that would be a 9-bar channel. Would be 9 bars would be 3 days. So it's a rolling 3 days, let's call it that way, rolling every 130 minutes. And the strategy that I put in here is actually supplied with TradeStation. I did not do any custom work with this. It's called a price channel long entry, price channel short entry. I had it loaded to the window, so I'm just turning the status on. And this is a sample of a strategy that there's no risk control in here. There's no position size optimization. None of that is in here. I took 2 years of data ending today. This is right through today. So there's an open short from a couple of days ago with this breakdown we've had. When we pop through the 9-bar high, we get long. Break down through the 9-bar low, we get short. Get long, get short. It's always in the market. So take a look at the results. Let me drag this over so you can see it. This is on 2 years of data ending today. All right. So take a look. About $3,700 in profit. I did take commissions out, by the way, so they did come out of this. And the $3,700, you think what you want. I don't care. It's in the market too much, and there's no maximization of anything. But it's interesting. Now we've had some good trend action, and I'm sure if you looked for the periods where the market was choppiest and least volatile, that's probably the toughest times. But what's interesting in looking at this is $3,700. Okay, so it made a little bit of money. 87 trades, and that's not bad for 2 years, but don't forget it's in all the time. So you do have a high exposure in that you're always in the market, including overnight. And one of the things that's interesting is percent profitable is 40%. So it's kind of, it's not great, but it's in the right zone for trend following. It's to be expected with trend following, but it's at the good end of the right zone. So I begin to think with a strategy like this, gee, if I could refine that and just get that to 43 or 45 or 46%, that would be really not bad. That's an important metric for trend following. Here's the equity curve. It's the right direction. It's not particularly consistent. This was the tough spot in here. And we're not going to break this down trade by trade. Remember, it's always in the market. So the risk-adjusted metrics are not going to be particularly good. There's a lot of overnight exposure. In fact, if we look at the drawdowns, some of the drawdowns are probably not acceptable. And by the way, it was set up as 100 shares on every trade. It was not capital allocation or any trade size algorithm. And the reason I usually start with this is because people who are new to strategy trading are saying, where do I even begin? Well, this has merit. This has some promise to it. We started with a foundation of how would I sample the data? What market am I interested in? How would I sample the data? Am I willing to hold overnight? Do I want to be a trend follower? We answer just a few of those questions, and we start to put together a model. Now I begin to think I need some risk control. Can I possibly filter out some of those trades? Maybe I change it so on a Friday I get out and don't hold over the weekend. That might damage the performance. I don't know. But those are all reasonable ways to approach refining this and moving forward. Now I want to talk about the other type of strategy. We'll take another, this is trend following. We'll take another look at a trend following in a minute. But I said I broke strategies down into two very broad categories: trend following and mean reversion or contrarian. And we'll look at a sample of that. We'll look at two samples of each. So what is mean reversion or contrarian? Buy low and sell high. This is an attempt to bottom pick. A mean reversion or a contrarian trader should have a higher win rate, but is generally going to have a smaller profit per trade. Now this is really hard to compare apples to apples sometimes, because trend followers are very often longer term, not necessarily long term, but longer term oriented compared to a contrarian trader who might be trying to pick off trades, let's say. So it's a little hard to compare. But this is generally, I'm looking for some high probability trade. I get something out of it, I take it. I am not looking to go for the ride. And by the way, on that higher percentage of winning trades, I was very clear before with trend following when I said that you can expect a 30 to 40% win rate, at least in raw tests. And if you can beat that metric, that's an important thing to look for. Because imagine if you could just take out a few of the losers, you push the win rate and trend following up maybe beyond the 40%. I don't have a historical metric for this, but I would be targeting somewhere in the 60 to 70% range. Remember I said before, if I get 10 trades a day and I can be right on 6 or 7, that's the kind of idea that I was alluding to, whether it's day trading or not. Higher percent of winning trades, less profit per trade. What's the psychological challenge? You got to buy into a falling market. Sometimes you're picking the bottom. I'm going to show you an example of that in a minute. And in this case, when you get the price action you expect, or the price action the strategy expects, it picks the bottom, it gets that rebound rally, you have to take the money and leave. That was your part of the action. That was what you were trading for. And of course, with all trading in any style, you have to manage risk. You have to cut losses somehow. Okay, Carlos has been very verbose, and I'm not ignoring you. I wanted to get through that, and we want to take a look at a few of these strategies. But let me allude to some of the things that you've been talking about. Reactive or predictive. I won't even characterize myself in what I do. I'm speaking now representing my company and as something of an academic. But in that sense, I would have to say that I'm reactive. I'm looking for the market to show me something based on history. I do a lot of work with oscillators and moving averages. And I would define that as reactive, I guess. Beyond that, we could probably have a discussion, and that would be a pleasure, but we won't do it right now over a webinar. The quote you put up, I think, is a very good one. There's something else I would mention. I haven't spoken at all, and I won't, about the best type of analysis. What should I use? In some ways, there are some who would say it's not what the analysis is. It is the implementation. That's what Carlos was saying. But beyond that, it may be the ability to manage the trade size. There are many tools that you can use that will give you a trend indication. However, can you determine in some way which are the better signals so that you take every buy signal, but you can qualify them, and on some buy signals you take a single unit, on some buy signals a double unit, on some buy signals a triple unit. That, I think, is step 2. Someone I've heard speak at many technical analysis conferences, or several of them at least, who's done some interesting work on strategies. I won't mention his name only because if you're interested, you can send me an email and I'll refer you to him. He does some interesting work. But he always says when he works with institutions or private clients, he likes to look at the raw signal. He said, don't talk to me even about exits, about stops, about trailing stops, about trade size. He just wants to know, does the signal have any edge in it? If the signal has no edge in it, then where are we going? Meaning that if I get a signal, am I more likely to get a favorable 1% move or an unfavorable 1% move historically? I'm throwing that out as an example. And if it turns out that the signal has an edge in it, then we begin to maximize, manage risk, maximize profit, maybe look at ways to manage trade size. Those are all secondary. But does the signal have any edge in it at all? Okay. Let's take a look at one mean reversion example, and then we'll take a look at another example of each. So this is a strategy that actually we used to write in one of our easy language classes. I think it may still be in the curriculum. I'm not even sure. And it's meant to be contrarian. It's mean reversion. So the chart that you're looking at, this is Forex. It's cable. It's a 24-minute bar chart. 24 minutes, you say, should send you to your calculator. How long is the trading day? 1,440 minutes, 24 minutes, 60 bars per day. Not a magic number, but it gives me a little bit of, it drills me in a little closer to the market than a 60-minute. Without being minute, I don't want to get down, in this case, to the level necessarily of a 5-minute or 12-minute. Now, if you see the Show Me study that's on here, and this is supplied with TradeStation, each of these red dots, let me push the bars apart a little bit so you can see it. Hang on, I don't want to make you car sick here, but stay with me a minute. So each red dot means that there were 6 higher highs in a row. 1, 2, 3, 4, 5, the 6th highest high in a row. And if there are consecutive dots, it means that now it's 6 plus 1 more. And each blue dot means there were 6 lower lows in a row. So we would see 1, 2, 3, well, I think I counted in the wrong spot. 1, 2, 3, 4, 5, 6. And if you see a couple together, it means more than 6. So each bar, we're looking back 6, or looking at the 5 before it, and seeing how many lower lows we have. Strictly a mean reversion idea. So what we're going to do is when we get 6 lower lows in a row, we're going to buy. Look for the bounce. 6 higher highs in a row, we're going to sell short. Look for the bounce. Look for the sell-off. So let me turn the strategy on. As I said, the strategy itself is not supplied. It's from one of our classes. If anybody wants, I can give it to you through Bennett Gene if you like. Okay. Now this also does have a stop and a profit target because it's not trend following. If we don't have a profit target for mean reversion trading, we have no idea if, we would just sit on it until the next trade. That doesn't make any sense. So just so you can see what's on the chart, 6 lower lows, we buy into that, profit target. The settings I have are $600 profit, $600 risk. And they're inputs. You can play around with them if you like. And then we have a short, stop loss. There may not be a trade in here because we have to get at least, if you see my inputs, we need at least 1 tick or 1/10 of a pip. I'm sorry, 1/10 of a pip to get through, to get our limit order filled. So we may not have been filled on a limit down there. I'd have to check the exact numbers. So if you're wondering why there's no trade there, it's a legitimate question. So here's the equity curve. We'll come to that in a minute. So here are the results. In this case, this was also 1 year ending today. I usually like to take data samples that are a little more historical, like push them back so I'm not thinking about today, but I just put these together so that we get an idea. Now this is not day trading. This holds overnight, but I think this may have been what one of those questions was coming at earlier. Well, what does overnight mean? Well, Friday night it means over the weekend, but otherwise it means over the 2 to 4 minutes that there's a break in between the trading. So I may not be uncomfortable with holding overnight in this case. I may not be. So there's not a bad return for 1 year. I don't know what the drawdowns were. You can look at it more closely. What's interesting, 61% profitable. That's what I was saying earlier. In a mean reversion or contrarian strategy, what would I want to get? Well, gee, I'd like to target 60 to 70% because I'm not looking for home runs. I'm looking to catch relatively high probability credits to my account. I think what's also interesting, by the way, is that the win rate is consistent on both sides of the market, which is kind of nice. There's kind of a nice symmetry, especially considering we've had a variety of trends. Some of the holding periods may be too long, but I wanted to get the idea that a strategy doesn't necessarily come from recreating mathematics. It often comes from, let me get a sound idea, what direction do I want to go in, how can I set up at least a test to get an idea, am I on the right track? The 6-bar high and low was also not magic. I did do a little bit of testing. This is not fully optimized. I don't want you to think that I went back and optimized it and just found something great. But I had done a lot of work with this, and I always found numbers 6, 8 were pretty good for this kind of a mean reversion kind of swing. Now let's take a look at another mean reversion. Actually, take a look at another mean reversion strategy. Now this one I published, and if you haven't seen the paper, you're welcome to it. And I'm going to take advantage of this little tool here in our player. And let's see if I can do this right. Okay. It's a paper that was published on our website. And you're welcome to read the paper in more detail. It was a mean reversion idea. It's called a Strategy Concepts paper. And I'll tell you what the idea was. We're running a little lower on time, so let me get through these last couple of ideas. So the chart you're looking at is Euro, 24-minute. And here you see a conventional RSI, a 14-bar RSI. RSI is a relative strength index. It's a standard indicator. It's considered a momentum indicator. And usually we look at it for overbought and oversold. Is it up near, is it up above 70 or 80, or is it down below 30 or 25? But I took a different approach in this, and it's all documented in this paper. And in fact, if you have TradeStation, you can download and plug it right into your platform if you want to experiment with it. Instead of looking at the actual level of the RSI, I decided, let me look and see if I can find places where the RSI has moved a lot, where it's gone from, where there's, I called it RSI travel because where it's moved a lot. And that's what this indicator is. It's not the RSI, but this is a picture of how far the RSI has moved. And you'll notice I have a line at 40 and negative 40. I hope you can see that over on the right. So in my experiments, what I found, not a perfect number, and you can experiment with it, was that when the RSI moves 40 points from its recent high or low, we tend to get a swing back. That's what the experiment was. And I supplied the indicator. This is not the RSI. This is the movement of the RSI. This is the same chart. This doesn't have the RSI, but it has that my derived oscillator, and this has the strategy that trades it. Now, because it's mean reversional contrarian, I'm just scrolling back a little bit so you can see some. I'm going to compress it a little so you can see some of the trades. Because of that, I also, again, I had to put in a profit target and a stop loss. You can't just take the trade and just sit with it forever. You have to have some way out. So I used a very simple ATR, average true range concept, for the exit. And that's where you see the green would be the target, the profit target. The red would be the stop. And they're symmetric. You can change that. You can experiment with it. You can read the paper if you like. So here you'll see we had a buy signal and stopped out. Here you'll see we had a buy signal and it hit our target. Short signal, and actually it reversed. It reversed profitably, but it reversed. It never hit either target for the signal. Now this also is not purely day trading, and the trick in defining day trading would be to define the day when it comes to Forex, which I did for futures in the next example. Now this was obviously a little more complex than 6 higher highs or 6 lower lows. But I think you can see that the theme is, if I start with a foundation, I have an idea, and I begin to move forward, I can experiment, but you have to be something, all science is a little bit of creativity and a little bit of science. So you have to put some logic in it, It should be on a logical foundation. It shouldn't just be switching from a 7-minute bar to a 9-minute bar. But you do have to be a little bit creative also with how you use some of the tools. Don't expect perfection. It doesn't happen. It doesn't exist. All right, the last thing I'd like to share with you, and I will take a couple more questions at the end, is something I haven't yet published. It's due for publication next month. So you'll be hearing about some of our new publications related to strategies starting next month. It's scheduled anyway. And the chart you're looking at is the E-mini S&P. The chart you're looking at is the full 23.25-hour day. The bars that you see in magenta are what we would usually consider the U.S. the day session. So I just painted those. And it's actually not the full day session. It's 9:30 Eastern to 3:15 Eastern. Because I decided in this strategy to say, since this is for day trading, that I won't enter after 3:15 Eastern because it's just too late in the day to get a new signal. Now, if you look at the two lines, those are moving averages, but it's not the moving, they are, usually when we look at two moving averages, we look at an average, two averages based on the same price of different lengths. Two averages, same price, like the close, different lengths, 5 and 20, 20 and 50. These are two averages of the same lengths, they're both 20, but based on different prices. One is the high, one is the low. And that's why it creates a channel they can never cross. So here's the rule. During the trading hours that are acceptable, and that's when these are magenta, during the acceptable trading hours, if a bar completely clears the upper line, it's a buy signal. Or if it completely clears the low, whoops, I just had a bear signal there. I think I just go past it. If it completely clears the lower line, it's a short signal. And then the opposite line becomes the stop. And the goal in this was to capture what sometimes we call trend days. You know, sometimes we have the days when the market just goes in that direction all day and you just get that persistence all day. And that was the idea behind this. Now, in order to do that, I had to limit the entries to certain hours. The entries are limited to those hours, 9:30 to 3:15, and at the end of the day, I'm out. So here was that example of that short end of day exit. The other exit is if it pokes through the upper band. There's a little tolerance in there, so I know it looks graphically maybe like it poked through, but it didn't by enough. There's a little bit of a gap in there. Here was a short signal, stopped out. Long signal, stopped out. This is not up through today. Short signal, and it rode all the way down to end of day. Never touched that upper line again. Again, the idea is to capture trend days. Not to capture every trade every day, but trend days. So here's what the P&L looks like. Give you some idea. Now this was 5 years ending June 30th. This is not up through today. And the reason is that I'm preparing this for a paper. So I had to truncate the data when I started working on this a month or two ago. And so I said, let me just truncate the data on June 30th. So a reasonable profit, it's 5 years, don't forget, so don't get carried away with that. Interesting, even for day trading trend following, 37% of the trades are profitable. I found that quite remarkable. Now, if you can stay with me another minute, I want to show you one other point about this, because I found this very interesting when I wrote this strategy. We're going to publish it next month, so you'll be able to get it. What I found most interesting, by the way, here's the equity curve. So there were a number of slack periods, but I didn't optimize it. The general direction is right, but there are slack periods in there. What I found interesting, the way I set this up, because I wanted it to be day trading specific, I set up a rule for the maximum number of trades per day. Max trades per day, and I set it at 1. So once you get a trade, that's it. No second trade. And I have not optimized all these rules, the trading hours, but I was messing around with this. I'm not even sure how I'm going to put this in the paper, but I said, you know what? What if I get more signals during the day? And considering I'm looking at a 15-minute bar, I'm not going to get that many signals in the course of those 6 or so hours. So let me run this one optimization, this is fascinating, on the number of trades per day. And I'm running this against a fair amount of data, so just give it a couple of seconds. What I found, and you'll see in a minute when I open up the results, is that this really actually did a better job than I expected, at least in the concept of finding the trend days. Because what happens is we'll look at the optimization report. I don't know if you've ever looked at one of these before. Give me 1 second. Let me make this a little easier to see. Let me just push the font up a little bit. Okay, that should be adequate. Really only need the first few columns, and I'm going to sort this in descending order. So let me just highlight this because the green is a little hard to see. Do you see that 15,000 some odd? One trade per day was far superior to taking multiple signals during the day, which means that after the first trade of the day, it only gets worse to keep on trading. I found that interesting. I don't know. I hope that rings a bell for you. Because the temptation is, well, why shouldn't I keep on going if I'm getting multiple signals? But really, this actually did a better job than I expected, at least in that vein. I'm not trying to sell you on the strategy, but at least in the vein of saying, does it capture the trend day? When I get those big days, I want to get that ride. When I get the whip, I get one whip, I'm done. I thought it was kind of interesting to bear that out. And that's one of the reasons we make, we create an input like max trades per day, because that way I can test it. I can actually run the optimization and let it keep on trading and see what happens. And the results only decay. Yeah, more trades provide the opportunity to give it back, Bob, exactly. I was very surprised when I saw this. And I didn't test more than 4 because I don't think you're really going to get that. You're not going to get that much. I mean, you could test it, but it's going to be a moot point because 15-minute bars, and you've got to be all the way above the top line or below the bottom line. Okay. All right. I think I've about exhausted you guys. Let me see if I can. Oops. There we go. I wanted to get back to this. I just wanted to put up my contact information one more time. If there's another question or two out there, I'd be glad to answer it. And let me see what's coming in. The channel in, let's see, which one? In this last one that I'm going to publish next month, Steve? Yeah. This, it looks like a channel because it's two, each one is a moving average. I'll show you exactly what it is, actually. I have a custom indicator for it, but you can replicate it with the one-line moving average. One is a 20-bar average. 20 is adjustable, but I use the 20-bar average of the highs and a 20-bar average of the lows. So that they're the same, it's two moving averages, same length, different price value. And they can never cross because one is based on what has to be a higher data series than the other. Moving average of the highs, moving average of the lows of the same length. They never cross. Institutional supply and demand trading strategy, is it mean reversion? That's a good question, Carlos. I know some of our friends at OTA often talk about supply and demand strategies or trying to identify those key areas. I don't know all their work really well, but just in listening to some of the talks that they give publicly, I don't really know their classes. I would have to say, I don't even know if it's mean reversion. I think it's contrarian. It may or may not be. It's contrarian in that you're looking for the market to move to a zone of demand or a zone resistance, support or resistance, whether you're looking at it based on what you expect or perceive or have analyzed as institutional areas or other reasons. So I guess it's contrarian in that way, and that you're fighting the flow a little bit. I don't know that it's quite so mean reversion. The reason is, now we're getting into sort of subcategories. Whoops. This I called mean reversion, even though we're not trading a moving average. We are trading a momentum oscillator, swinging back, following having a large swing and then swinging back. I don't, in this work, no, Bob. I wouldn't look at necessarily at typical typical minute bars. In some cases, yes, there's nothing wrong with that. I mean, Forex, to look at 120 or 240 minute bars, there's certainly nothing wrong with that. I have a spreadsheet that I use that I put in the length of the trading day. And this gets trickier now with futures or Forex. I'll make one more point on that, and then we'll try to tie this up. But I can plug in the length of the trading day, and it gives me the whole number of factors. So, and the whole number of factors let me see what number of bars I want to get, meaning how many data samples I want to get per day. Now, so the world is now different with 24 or almost 24-hour markets. I have to recognize that. It was a little easier in the old days when corn market was open for 3 hours and 45 minutes every day. It was a gentleman's game. You could have breakfast, nice breakfast, trade for 3.5 hours, and then go have a nice lunch and go home. But I think it's important, and that's what I was alluding to here. I've discussed this with currencies, but not tonight. But in this strategy, I went for the idea that even though this is an almost 24-hour market, I don't want to trade at 24 hours. I don't need this grief. Now, overnight, there are sometimes moves. I realize that. But when is the real juice in this market? The S&P tends to move when the U.S. economy is open. And I'm going to pass on the rest of it. I'm going to watch sports on TV. I'm going to enjoy my family. And I'm going to go out and get some air and some sleep. I'm overstating that a little bit, but I think you see what I'm driving at. In this strategy, I chose those are my trading hours. I will enter starting at 9:30. I will take no entry after 3:15, and I'm out at the end of the day in any case if I have not otherwise gotten stopped out. I think it's worth doing that work on Forex. Now, I did not do it here, but for quote-unquote day trading Forex, I think you have to identify the windows, whether it's Asia, London, New York. Identify the window. We have a paper published on that. My colleague Fred Pomleden did some nice work on analyzing the volatility curve over the 24-hour day in identifying, gee, what is the best time to trade certain markets? Well, London is the leading market, so things tend to be there, but the U.S. dollar is most important. So sometimes the best time even to trade an exotic pair is when the dollar is open. And it's legitimate to say that those are my trading hours because that's when the action is. The rest of it I won't trade. One subtle point. It's not so subtle. I made the point a big deal here. That even though I'm only trading those hours, notice that my technical analysis is being done on the full market day. That, I think, is important because if I cut this down to what's in TradeStation, the .D symbol, or some custom session, and I know we have TradeStation veterans there who know what I mean, then my moving averages would be based only on the data in the chart. I want the averages based on overnight. I want them to pick up where we've come from Europe. But I'll only trade during the U.S. session. You could obviously work with this, maybe 8 a.m. instead of 9:30, 8 a.m. Eastern instead of 9:30. You can be flexible with that. I don't mean to be so rigid, but I do think you have to have some rules on when that's going to be, unless you are, unless you're missed the data and you don't need to sleep. Well, I guess, Bob, if you take that away, that's pretty good, but give me a little more credit than that. Yeah, I would say that that's a reasonable takeaway. Think and model the ideas, but start you're going to have to start step by step a little bit. I know you've done some work in this area, but if you're new to this, what are you trying to accomplish? What is my data sampling? What does the chart look like? What kind of price action am I trying to capture? Smaller swings, bigger trends, over what time frame? And begin the model. I'm going to take the risk and say this. The model does not have to have extreme risk control for a first set of tests. Now, I don't want to mislead you on that. I don't want you to go in the wrong direction and trade without having risk control. And I know Bennett does tremendous work in that area. But really, to start to model a test, what you're trying to see a viability of a signal. Is this at all giving me an edge? And that's what I refer to that colleague of mine who has given talks on those ways. Forget all the details to begin with. Does the signal represent any edge? Does the signal represent seeing something through the noise? And base it on a sound foundation of data and analysis. All right, I've probably gone on long enough, and I appreciate your questions. And I appreciate the time and staying with me, and I appreciate Gene and Bennett not giving me the hook.
We'd never do that, Stan. We'd never give you the hook, Stan. Can you hear me?
Yes, thank you.
So I guess my headset is better now?
Yes.
That's a good thing.
I return the floor back to you, and I thank my hosts once again.
Stan, thanks so much. That was a really terrific presentation, and I think it gave everybody a lot to think about. Also, too, I think Stan gave us some information here. Let me make sure I post this in the chat area so that you can get these links. Bear with me one moment. I'm going to copy it and then post it here. Excellent. I think this, Stan, tell me if I'm posting the right thing. Is that the paper that you want people to be able to look at, what I just posted?
Yes, it is. I didn't realize I sent it just to you. Thank you very much for putting that link in, Gene. That's
Perfect.
a paper that's on our site. It discusses this RSI travel strategy. And if you have TradeStation, you can download the easy language. You can mess around with it. And if you know some easy language, you can make some edits and have some fun.
Excellent, excellent. Well, terrific. I hope everybody takes advantage of that. And, of course, if you have questions for Stan, you can contact him directly, or you can always reach Bennett or myself, and we will give you Stan's information. Again, thank you so much, Stan, for being here, and thank you all of our attendees. It's good to have you here. We will be having another terrific Wednesday Night Live next week, so we hope you'll join us next week and in future Wednesday Night Lives, and I hope everybody has a terrific night. Thank you for coming.
Thank you so much. Have great holidays, everyone. Come to the charity event Friday.